Every time someone promises you a 20 or 30% yield, your brain should scream scam. And most of the time, it's right. But what if I told you the real danger isn't losing money fast? It's watching your money quietly rot while you think you're getting paid. Today, I'm breaking down the few funds that actually pay massive income without eating themselves alive, and why 90% of people chasing dividends never notice the difference until it's too late. Every time people hear about an exchange-traded fund paying 20%, 30%, or anything close to that, the instinctive reaction is suspicion. It feels like a trick. Years of conditioning in finance have taught investors that high reward rarely comes without high risk, and when income looks too good to be true, it usually is. Most people have seen the stories, sometimes lived them personally. A portfolio that looked brilliant on paper slowly collapses in silence, while payouts continue to arrive like a magician distracting the audience with one hand while the other empties their pocket. That is why the real question is not whether high yield exists, but whether it can exist without quietly destroying the capital underneath it. The reason this matters is simple. Income investing is supposed to solve a problem, not create a new one. The promise of dividend income is stability, predictability, and eventually freedom. But what happens far too often is that investors chase yield without understanding where it comes from. They celebrate monthly deposits while their principal erodes, and by the time they notice the damage, the compounding engine they thought they had built is already broken beyond repair. The tragedy is that this outcome is not inevitable. It is not a law of nature. It is the result of structure, incentives, and design choices inside the funds themselves. To understand why some high-yield strategies fail while others survive, you have to look beneath the surface. Many income-focused funds generate cash flow not by creating value, but by liquidating it. They return capital disguised as income, slowly shrinking the base that future returns depend on. This is why an investor can receive thousands of dollars in distributions and still end up poorer over time. The income feels real, but the wealth is being hollowed out from the inside. It is financial erosion disguised as generosity. There are, however, a small number of funds built differently. These funds are not chasing yield by taking reckless bets or sacrificing long-term growth entirely. Instead, they are designed to monetize something that already exists in the market and that most investors ignore: volatility. Volatility is usually treated as an enemy. Prices swinging up and down create anxiety, losses, and uncertainty. But for structured strategies, volatility is not a threat. It is raw material. When handled correctly, it can be turned into income without requiring the underlying assets to constantly rise in price. One of the clearest examples of this philosophy is a fund built around the backbone of the American market itself, the companies that make up the broad equity index most investors already own. The genius here is not in exotic assets or speculative plays, but in how familiar assets are used. Instead of attempting to outperform the market through aggressive stock picking, the fund accepts market reality and builds guardrails around it. It holds large, established companies that dominate their industries, firms with deep liquidity, global revenue streams, and entrenched competitive advantages. These are not moonshot startups. They are the infrastructure of the modern economy. What changes everything is the overlay strategy. Rather than simply holding stocks and hoping for appreciation, the fund systematically sells call options against the market exposure it already owns. Every time investors elsewhere are willing to pay for the right to capture upside, the fund collects that premium as income. When markets are calm, those premiums are smaller but steady. When markets are volatile, premiums expand dramatically. At the same time, protective mechanisms are layered in to limit catastrophic downside. This is not about gambling on direction. It is about harvesting behavior. Historically, option premiums spike during uncertainty. Earnings seasons, macroeconomic shocks, geopolitical stress, and interest rate changes all inflate implied volatility. Most investors suffer during these periods because price movements feel unpredictable. Structured income strategies, by contrast, thrive in this environment. They are designed to sell fear and monetize uncertainty. That is why these strategies often perform their intended function precisely when traditional portfolios feel the most uncomfortable. The real differentiator, though, is discipline. Low turnover matters. Funds that constantly trade incur costs, generate taxable events, and often signal a lack of structural confidence. A rules-based system that executes consistently without emotional interference is far more likely to survive across decades, not just market cycles. This is where many high-yield products fail. They are optimized for marketing, not longevity. They look attractive in short backtests but collapse under prolonged stress. When these principles are applied correctly, the results compound in a way that surprises people. A modest initial investment can grow not because the market explodes upward, but because income is reinvested into a stable base that does not decay. Over time, the snowball effect becomes obvious. The income increases, the capital base expands, and the relationship between effort and reward becomes asymmetrical. This is the quiet power of structured income done correctly. Another example of this philosophy appears in an asset class traditionally associated with safety rather than income. For centuries, gold has been treated as a store of value, a hedge against inflation, currency debasement, and systemic risk. What it has never been known for is cash flow. Gold does not produce earnings. It does not pay dividends. It simply exists. That limitation has kept it out of many income portfolios despite its defensive properties. Modern financial engineering has changed that equation. By combining conservative fixed income instruments with options linked to gold's price movements, it becomes possible to extract income from gold's stability without relying on price appreciation alone. The brilliance of this approach lies in its restraint. Instead of chasing gold's upside aggressively, it accepts limited gains in exchange for consistency. Option premiums provide cash flow, while buffers absorb moderate declines. This creates a smoother return profile that behaves differently from equities, offering diversification that is functional rather than theoretical. Historically, gold performs best when confidence in financial systems weakens. Inflation spikes. Monetary, policy uncertainty, and market stress all tend to benefit gold. When these periods coincide with elevated volatility, option premiums expand, increasing income potential. This creates a rare alignment where defensive positioning does not require sacrificing yield. The result is an instrument that stabilizes portfolios during turbulence while continuing to generate cash flow. The key insight here is that income does not have to come from growth. It can come from structure. By designing systems that earn regardless of direction, investors are no longer dependent on perfect timing or constant optimism. They can be paid for patience, discipline, and emotional neutrality. This concept becomes even more powerful when applied to sectors known for rapid innovation and dramatic price swings. Few areas of the market embody volatility more than semiconductor companies. These firms sit at the center of modern technology, powering everything from smartphones and data centers to artificial intelligence and autonomous systems. Demand cycles are intense, competition is fierce, and valuations can swing violently in response to earnings reports, supply chain disruptions, or macroeconomic shifts. For most investors, this volatility is stressful. For structured income strategies, it is fuel. By holding a concentrated basket of semiconductor leaders and systematically selling options against them, income can be generated at levels far beyond traditional dividends. The trade-off is straightforward. Some upside is surrendered in exchange for predictability. But for investors whose primary objective is cash flow rather than speculative growth, this trade-off is often rational. It is important to be honest here. Covered call strategies cap upside. When markets surge, these funds will lag pure equity exposure. Anyone who expects to capture the full explosive growth of a bull market while also receiving massive income is deluding themselves. The strength of these strategies is not dominance in every scenario, but resilience across many. Long-term data supports this. Income-focused option funds tend to produce modest capital appreciation while distributing substantial cash flow. Over time, reinvestment bridges the gap between growth and income. What looks like stagnation in price can still result in significant wealth accumulation when distributions are compounded intelligently. This principle reaches its most extreme expression in assets that are volatility incarnate. Digital assets, particularly those linked to decentralized networks, are infamous for dramatic price movements. For traditional investors, this volatility is often intolerable. But for option-based income strategies, it represents unprecedented opportunity. By structuring exposure through regulated vehicles and overlaying disciplined option selling, it becomes possible to harvest volatility without directly holding speculative assets outright. The result is a hybrid structure. Conservative instruments anchor the portfolio, while exposure to volatile assets generates income through premium collection. This approach transforms chaos into consistency. It does not eliminate risk, but it reframes it. Instead of betting on price direction, it monetizes price behavior. What makes this approach compelling is not that it produces the highest theoretical returns, but that it produces usable returns. monthly income that can fund real expenses, cash flow that is not dependent on liquidation, growth that occurs quietly in the background rather than explosively and unpredictably. Over long periods, this kind of structure can turn modest starting capital into meaningful financial independence. The common thread across all of these strategies is intentional design. None of them rely on luck. None of them promise miracles. They acknowledge trade-offs openly and optimize for sustainability rather than spectacle. They treat volatility as an asset rather than a liability. They respect the difference between income and capital, and they refuse to sacrifice one blindly for the other. This is the real lesson. High yield is not the enemy. Ignorance is. Yield without structure is decay. Yield with discipline is leverage. The difference between the two is not obvious at first glance, but over years, it becomes impossible to ignore. And this is only the foundation. What comes next is where the compounding accelerates, the strategies intertwine, and the numbers begin to separate dramatically. The second half goes deeper into how these structures behave over long horizons, how reinvestment reshapes outcomes, and why certain combinations outperform everything else when time is allowed to do its work. Once the foundation is understood, the real advantage begins to emerge, because these strategies are not meant to exist in isolation. They are designed to work over time, and time is where most investors either win quietly or lose loudly. The mistake people make is evaluating income products the same way they evaluate growth stocks, by looking at short-term performance and headline numbers. Income strategies demand patience and structural understanding. Their power does not show up in weeks or months, it shows up in years, when reinvestment compounds and volatility repeatedly pays rent instead of demanding payment. Consider how most people experience market volatility. A sudden drop in prices triggers panic. A sharp rally creates fear of missing out. Emotional reactions lead to bad decisions, buying high and selling low. Structured income strategies flip that experience entirely. Volatility becomes productive. Every sharp move increases option premiums. Every uncertain period increases income potential. Instead of dreading instability, the investor begins to welcome it, because volatility is no longer a threat to survival, but a contributor to cash flow. This shift in perspective is not just theoretical. It mirrors how professional trading desks and institutional investors have operated for decades. Insurance companies, pension funds, and endowments rarely rely on pure directional bets. They structure portfolios to extract income from behavior, not prediction. Options exist because markets are emotional. Fear and greed create demand for protection and leverage, and that demand carries a price. When structured income funds sell options, they are selling certainty to others in exchange for premium income. That transaction is the engine behind sustainable yield. The difference between success and failure lies in how that engine is managed. Poorly designed funds overextend, sell too aggressively, or lack adequate protection. Well-designed funds balance exposure, cap upside intentionally, and build buffers against drawdowns. They accept that they will never be the best performer in a raging bull market, because that is not their job. Their job is to survive all markets and pay consistently while doing so. Over long periods, this restraint becomes an advantage. A portfolio that avoids catastrophic drawdowns does not need heroic gains to recover. It compounds quietly. This is why two investors starting with the same capital can end up in radically different places after 10 years, even if their average returns appear similar on paper. Volatility drag destroys fragile strategies. Stability amplifies durable ones. Reinvestment is the accelerant. Income that is consumed produces lifestyle benefits. Income that is reinvested produces exponential growth. The difference between the two is not intelligence, but discipline. When distributions are reinvested into strategies that do not decay, the compounding effect becomes relentless. Each payment increases future payments. Each cycle reinforces the next. Over time, income becomes less dependent on new capital and more dependent on structure doing what it was designed to do. This is where most people underestimate the outcome. They assume linear growth. They think in terms of simple accumulation. But income strategies, when reinvested, do not grow linearly. They grow recursively. Each layer of income becomes a new base that generates its own income. Eventually, the numbers stop feeling intuitive. What started as modest monthly payouts becomes a meaningful annual cash flow that rivals salaries, then exceeds them. The psychological impact of this should not be ignored. Financial stress often comes not from lack of wealth, but from lack of predictability. Knowing that income arrives regardless of market mood changes behavior. Investors stop reacting emotionally to headlines. They stop checking prices obsessively. They stop making impulsive decisions. Confidence replaces anxiety, not because risk disappears, but because risk is accounted for structurally. This is particularly important when dealing with assets that are traditionally viewed as speculative. Digital assets are a perfect example. Most people associate them with extreme swings, overnight fortunes, and devastating losses. Directional exposure magnifies that perception. Structured exposure reframes it. By limiting upside deliberately and harvesting volatility instead, income strategies remove the need to be right about timing. They do not require belief in a narrative. They require belief in mathematics and behavior. When volatility spikes, premiums rise. When prices stagnate, premiums still exist. When prices fall, prior income cushions the decline. This is not magic. It is probability management. Over time, repeated premium collection smooths outcomes. The investor is no longer betting on a single outcome, but on the persistence of market emotion itself. There are real-world parallels to this approach outside finance. Think of landlords who prioritize steady rent over speculative property flipping. They may not make headlines during housing booms, but they build durable wealth over decades. Or insurance companies that collect small premiums from millions of clients, knowing statistically that payouts will be lower than collections. These businesses do not rely on optimism, they rely on structure. The same logic applies here. Income-focused strategies are closer to businesses than bets. They generate cash flow by providing a service the market demands. Protection, leverage, and certainty all have buyers. The funds that sell these products responsibly can do so indefinitely. The funds that sell them recklessly burn out. Another critical element is diversification of behavior, not just assets. Holding multiple income strategies that respond differently to market conditions reduces dependency on any single outcome. Equity-based volatility behaves differently from commodity-linked volatility. Technology sector swings differ from defensive assets. Digital asset volatility operates on an entirely different rhythm. When these are combined intelligently, income becomes smoother, not lumpier. This is where portfolio construction becomes art rather than arithmetic. It is not about maximizing yield on paper. It is about maximizing survivability. The investor who earns slightly less but never has to liquidate during a downturn often outperforms the investor who chases maximum yield and collapses under stress. Longevity beats brilliance. History reinforces this repeatedly. The investors who win long-term are rarely the loudest. They are the ones who avoid ruin. They do not rely on perfect predictions. They rely on systems that function under imperfection. Structured income strategies are built for imperfect worlds. They assume volatility, fear, greed, and unpredictability as constants rather than anomalies. Over a decade, the difference becomes dramatic. Portfolios that decay require constant injections of new capital just to maintain income. Portfolios that compound begin to self-fund. Income grows faster than expenses. Financial pressure eases. Optionality expands. Work becomes a choice rather than a necessity. That is the real promise of income investing done correctly, not early retirement fantasies or overnight success, but sustained autonomy. It is also important to address the misconception that income strategies are only for conservative investors or retirees. That idea is outdated. In reality, income strategies can be powerful tools for younger investors precisely because of reinvestment. Time amplifies their effectiveness. A younger investor who reinvests aggressively can turn volatility into an ally early, building a base that later supports consumption without sacrificing capital. The discipline required is not technical. It is emotional. The hardest part is resisting the urge to chase growth when markets are euphoric and resisting panic when markets collapse. Structured income strategies remove much of that temptation by design. They trade excitement for reliability. For many, that trade-off is worth far more than it appears. Ultimately, the question is not whether these strategies work. The data, history, and logic all support their effectiveness when implemented correctly. The real question is whether the investor understands what they are buying and why. Income without understanding is dangerous. Income with understanding is powerful. What separates those who succeed from those who fail is not access to information but alignment between goals and structure. If the goal is consistent income that grows over time without destroying capital, then structure matters more than yield. It always has. The quiet truth is that wealth is rarely built by dramatic moments. It is built by systems that function day after day, month after month, year after year. Structured income strategies are not exciting. They are effective. And over time, effectiveness compounds into outcomes that once seemed impossible. That is the real story behind high yield that does not decay. It is not about chasing numbers. It is about designing systems that respect reality, monetize behavior, and allow time to do what it does best. High-yield ETFs. It starts by confronting the uncomfortable truth that most funds advertising massive monthly payouts are not actually creating wealth. Instead, many of them slowly return an investor's own capital while the underlying portfolio quietly decays. What feels like income is often just money being handed back, leaving investors poorer over time even as they celebrate high yields. From there, the script reframes the entire conversation around income investing. Rather than chasing the biggest advertised percentage, it explains that sustainable income comes from structure, not hype. The core idea is simple but powerful. The way an ETF generates income matters more than how much it claims to pay. Funds that rely on disciplined option strategies, volatility, capture, and downside protection can produce high income while still preserving or even growing capital over the long term. Each ETF discussed serves a specific role in that larger framework. Some convert stock market volatility into consistent premiums while protecting against sharp drawdowns. Others transform traditionally non-income assets, like gold or Bitcoin, into cash flow-producing investments without requiring direct exposure to their full-price swings. The script emphasizes that these funds are not magic, risk-free solutions, but carefully engineered tools designed to trade explosive upside for predictability, consistency, and income stability. Throughout the narrative, long-term projections reinforce the central message. When income is reinvested and the portfolio avoids decay, compounding does the heavy lifting. Over time, the difference between a decaying high-yield fund and a structurally sound one becomes massive, not just in account value, but in monthly income. What starts as a modest investment can grow into a portfolio producing thousands of dollars per month without selling shares, provided the strategy prioritizes sustainability over short-term excitement.